invite my panel to join me immediately, like this we right on time. So as they are settling in, I will start with my introduction. So we heard yesterday that blockchain in the trade finance space has a lot of potential, but it's still not yet there. We will need a few extra years of experimentation, of consortium work, of legal groundwork to make it happen. We also heard yesterday that on the payment side, at global scales, there's still a lot of challenges in terms of scalability and privacy in implementing a blockchain to do bank-to-bank cross-border payments. And that's a fact that we've experimented ourselves at Swift, trying to build a blockchain for a Nostro account reconciliation, a Nostro account visibility or liquidity management. And we quickly realized that having to manage 100,000, 200,000 sub-ledgers to create private channels between banks would be quite difficult to manage if we wanted to keep the privacy intact. So yes, the potential is there in payments, in trade finance, and in other areas. What about securities? What about securities post-trade? And when you look at this ecosystem, you can see that effectively in the securities post-trade system ecosystem today, many processes are very efficient. Clearing and settlement activities, for example, level of STP, straight-through processing automation, very high, no major challenges. But other areas like corporate actions or proxy voting, so that's the process of voting or shareholders voting at a general assembly, for example, is not really functioning well. Still a lot of paper, a lot of actors to be involved into the process. When you look at bonds trading, bond trading is still done a lot over the phone, not many trading platforms. The clearing and settlement activities are quite still very manual. And you have a series of processes in the security space that could potentially benefit from the implementation of blockchain. And that's what we will experiment or discuss today with our panelists. A last point I want to mention is that in the space of securities, we do see securities market infrastructures, clearinghouses and CSDs taking the lead. And for a very good reason. These post-trade clearing and settlement platforms have been running on 25-year-old COBOL-based systems for very efficiently, but the scalability of those systems and the even maintenance of those systems is becoming more and more difficult. And as they are looking at new technologies to replace their old technology, naturally they're looking at DLT and blockchain, with the most, I would say, visible one of them being the Australian Securities Exchange, ASX, who have announced that they will build a DLT-based system that will be live probably around 2020, that will take care of clearing and settlement of equities in the Australian market. So all these we will explore today with the panel, and I have a very good panel in the sense that it's a mix of financial institutions and a mix of financial technology companies. Two financial institutions, two financial technology companies. On the FI side, we have Margaret, who is Managing Director, Global Head of Security Services at Standard Chartered Bank. And we have Danielle Anderson, who you saw yesterday already, who is Market Advocacy and Innovation Research Senior Vice President at Northern Trust. And on the fintech side, if I can call you like that, beyond me, because we are arguably the first financial technology company existing in this world 40 years ago. We have John from Digital Asset, who is Business Development Director, and who will certainly talk about the ASX use case for sure. And we have Gangesh Gamesan, President and Chief Technology Officer of Peer Nova. So I'm going to sit and ask the first question as you can take this one, I think, as an introduction. Whoa, I feel lower than you. You left me this one on purpose, right? Yes.
The price of being the tall person.
Exactly. Okay, so the first question as a way of introducing yourself to the audience, could you explain why you got into the blockchain discussions, whether in the financial institutions you're working for or as a financial technology company, and what were you doing before, especially for you, John and Gangesh? Maybe starting with Daniel.
So look, I guess Northern Trust story for blockchain is 5 years old, so I guess that's a lot of history on experimentation, but really understanding the value to our clients. But I guess from a personal perspective, prior to joining Northern Trust, like many, perhaps I tried to start a startup and wanted to use the blockchain until we realised we didn't really need the blockchain. So that was very good learning, referencing our earlier conversation. Yes, so now within Northern Trust, it's really focusing on the Asia-Pac zone and how we can use some of the initiatives, particularly at the market infrastructure level, to benefit our clients and deliver that value from the blockchain through. So.
John?
So I was formerly with the Commonwealth Bank of Australia, one of the largest banks in Australia. I was in the Innovation Lab team, and as part of that, I sort of followed my nose. Found Bitcoin first, as I think most people do, and then Ethereum, and we started to build out a bunch of little prototypes and proof of concepts within that CommBank Innovation Lab. The very interesting thing that working for a major bank gave me was an insight into how much money is spent on technology inside major financial institutions and how little of it is spent on the interesting parts of technology. A very great majority of CBA's technology budget went to just keeping the lights on, to keeping compliance running within the technology systems that were there already, rather than building new and interesting things. And when the opportunity came to join Digital Asset in Australia and work on the ASX project, I did see an opportunity to move to something that was a bit of a step change. So that's how I got here.
Okay, great. My name is Gangesh Ganesan. I am based in Silicon Valley. We are a Silicon Valley-based startup. We've been around for about 5 years, which in sort of this world is a fairly long period of time. Immediately before this, I've been working in Silicon Valley for roughly about 25 years, and doing various roles. Ran a couple of startups, sold one company to Qualcomm, and immediately before this, I was actually doing a big data company, and we were doing streaming analytics on big data 5 years ago, which was 6-7 years ago, which was very new at that time, doing big data in real time. We ended up selling the company to Twitter. And I was between things, we had sold the company and was sort of looking for new ideas and sort of ran into Bitcoin at this time. Didn't know a whole lot, read the white paper and recall telling my wife, wow, this is such a cool thing. We have to start a company immediately on this. And pretty much me and a co-founder, we started a company. And this was in early 2013. At this time, we knew very little about Bitcoin, and there was very little to go do. Bitcoin price itself was fairly low. It was sub 100. It was sometimes very, very low, sub 50 during this time. So the only thing we knew was how to mine Bitcoins. So we started mining Bitcoins. And lo and behold, we became one of the largest mining networks in the world. Within about, I would say about a 9-month period, we had mined a ton of Bitcoins. We had actually mined 47,000 Bitcoins. And we were the largest mining network in North America. The vision was actually to understand more about this technology. And here we were running 10 megawatts of power, data centers around the world that were mining Bitcoins. Just a fairly small team, 6 or 7 of us in Silicon Valley doing this. And just FYI, for those of you that are still interested in mining, I at least kind of claim that it's not a very sustainable business. We ran it at scale. We had 10 megawatts of power and still found it to be not very sustainable. We did mine a chunk of coins that we used to bootstrap and start the software company, which is Pure Nova now. But the experience taught us a lot. During this time, we wrote our own mining, network software. We wrote our own wallets. So it gave us a lot of idea about how this distributed system worked, what to do and what not to do. And now we are, sort of building applications for large financial institutions. So sort of a bit of a digression around how we actually got into the space, but wanted to share it with you.
Thank you. Thank you. Margaret.
Okay, well, I think I'll answer the question by saying I'm actually not in the business of blockchain. As was mentioned by Alex, I work for Standard Chartered and I run globally our security services activity, which is business across emerging and frontier markets of Africa, Asia, and the Middle East. So you're immediately going to say, well, why the hell is she even sitting on that panel? My answer to that would be, when I think about the business that I'm running and the environment that we're in, We're all about enabling the investment process for our clients and the clients of our clients as they invest across those markets of Africa, Asia, and the Middle East. We need to stay relevant to those clients in order to maintain our commercial performance. Therefore, that means we're in the business of change, we're in the business of adapting, redesigning, remodeling process, operating models and services for our clients. So that's absolutely where blockchain, where DLT, where the deployment of new technologies comes in. So I'm on this podium because that's really important to Standard Chartered, that's really important to our clients, and we need to get that right to ensure our success going forward.
Thank you. So let's deep dive into the discussion on post-trade securities use cases. So as every company, Swift as well is, of course, testing the technology. The next one we will be testing on will be how can we apply blockchain to e-voting or proxy voting, as I mentioned earlier on, because there we do see a need and we do see a complexity. We will also be testing actually how interoperable systems can be built in the sense that not everybody will be able to deal with blockchain nodes from the beginning. So how can we integrate messaging as well as nodes management into it? Quite similar to what ASX is doing actually in Australia. Can you maybe share with us your projects in each of your institutions or one of your projects that you're working on today, either as a proof of concept or as a real implementation? And we can start with Daniel.
So I did share yesterday, but in case, so I think the main project at a firm level is the private equity blockchain solution that we delivered. It's a live solution with the fund and investors, and we've managed that through the investment life cycle of the fund over the last year, to the point where now we are looking to continue to scale and add additional clients on the platform and build the ecosystem out. So that's a global project, but our clients across the globe are interested, and so we are trying to understand how the infrastructure and architecture could be applied to other asset classes that have similar characteristics, so low throughput but high sort of post-trade inefficiencies around transaction friction and lack of transparency.
Okay. Margaret?
Let's hope we all pick something slightly different. So look, I'd start by saying, I think from a security services perspective at Standard Chartered, if I'm honest, we're still relatively in our infancy when it comes to deploying DLT solutions. Now, that's not to say that we haven't started to consider things in earnest, and we've had some ideas and some initiatives in train really over the last couple of years. Our focus is very much to see how sort of nascent technology can be used in the space of digital assets, including tokenization of real-world assets and virtual currencies. We're certainly seeing a lot of interest coming from the institutional investor community in that space. And I think, you know, we're taking heart or reflecting that there are some different characteristics around blockchain solutions. So the fact that trading is available 24/7, you've got fractional ownership, you've got rapid settlement opportunity, and also increasing liquidity. So certainly some attributes there that perhaps are different from the classic trading on some of the other asset classes, and I think lend themselves quite well to a DLT environment. So we're at the stage now where we're sort of evaluating the resources and costs and thinking about launching a blockchain solution. Now, as we do that, probably a couple of things come to mind. Firstly, we still need to be very cost conscious, so we want to make sure that any solution that we came to market with is commercially attractive for clients. So we're looking at things like off-chain channels, sharding, and other things, really to make sure that we are minimizing both the resource requirements in order to be cost efficient. And I think as well, over and above that, and probably this is a theme that will be remarked upon several times during the panel, we're trying to be very conscious that we should focus on what's the problem we're trying to solve. I think there's a real temptation and danger that, you know, we could rush down roads, we could start to develop blockchain solutions without being fully cognizant of the issue we're trying to resolve. So let's put the issue and the client at the center of our thinking, and as we heard earlier, you know, find as we consider how to solve a particular problem that DLT is the solution that we should deploy.
Makes a lot of sense.
Sort of echoing on that theme, when we first started our journey in sort of building distributed ledgers and blockchains, we were somewhat early on very naive. We walked around to some of the largest financial institutions in the world and said, well, here's a blockchain we've built. We had built one and sort of went and demonstrated it and had lots of meetings with them on it. And they'd give us the time. They'd actually, some of the largest institutions, institutions like people sitting here in the podium with us. And they'd look at it and say, well, okay, nice. This is all very interesting, but what is it for? What can you do with it? And we were really struggling to articulate a problem, simply because early on, sort of when blockchain sort of caught up, many of us who were actually building these kinds of DLT and blockchain applications couldn't quite articulate a problem. Over time, we've actually learned what the problems are. The very specific problem that PeerNova is looking to solve is a set of problems broadly that in the industry that we call reconciliations and trade validations. So I'll kind of give a quick description of what this problem is like. So if you think of sort of any kind of a trade scenario in a large financial institution, let's say, I'll just use an example, a large financial institution like Citi or JP Morgan, doing some trade of an asset. They have a very complex infrastructure inside their institution, a front office, a middle office, back office. In the front office, they're capturing all the trades. In the middle office, they're doing some consolidation, netting, risk, and a few other things, whatever is appropriate. And eventually, in the back office, they're doing clearance, settlement, and reg reporting, financial reporting, things like that. It's sort of a loose view of what's done in a front, middle, and a back office. Right? Now, it so happens that they're working with lots of different counterparties in CSDs and CCPs and other different market participants. The way it works is that today, at least, each of the market participants, on a nightly basis, for example, will send a report to, say, Citi. If Standard Chartered is doing some trades with Citi, on a nightly basis, Standard Chartered would send out a report to Citi saying, here's sort of all the trades we did, here's your obligations, here's the securities that moved around, and here's the cash you owe us, whatever the report might be, whatever is appropriate for that particular security we're talking about. So you get these reports. But as Citi, since they're a big, large bank, they'd get reports not just from Standard Chartered, they'd get reports from hundreds of their CCPs and banks. So essentially, on a nightly basis, you're ending up with hundreds of reports, each of which is, in one sense, to think of this report, is basically a state of the database from the other counterparty. The other counterparty has recorded all the trades, and they've captured the state of the trades as they believe the trades to be, and they're sharing this with you. Now, it is the job of Citi now to somehow resolve their internal books, and they have lots of different internal books, some for reg reporting, some for financial reporting, some for actual trade repositories and the like. They have to somehow match all of this data so that eventually they can present a unified view of this data. So this is sort of the broad problem of reconciliation. To do this, financial institutions over the last, I would say over the last 20 years or so, have developed very, very complex business processes for trying to do this validation of trade and reconciling of their internal books. Literally, they have thousands of people in their middle and back office. In the entire outsourced business that I would call BPO outsourcing and outsourced vendors in the financial services space like Wipro, TCS, Infosys, Cognizant, folks like that are all involved in this process. So a traditional financial institution like Citi may have tens of thousands of people who are all doing trade validation of this kind of data. So the kind of applications that PeerNova is focused on is how do you understand the workflows that are going on here? How do you simplify them? Can you automate them? And clearly, DLTs are appropriate for some of this, and blockchains can be used for some of this. Can the problem be completely solved by using a blockchain? Well, we think it's a bit of a stretch to say that. There's a lot of different components here, messaging, database technologies. How do you actually get all these things to work together in one cohesive view to simplify this flow? And that's essentially the type of problems we are looking to solve.
Thank you very much. John.
So Digital Asset to date has principally worked with major market infrastructures. We're very fortunate to have an investor base that includes a number of major market infrastructures around the world. The DTCC, Deutsche Börse Group, the CME, and perhaps most publicly, the ASX. As some of you may know, we've been working with the ASX since early 2016 and gone through a fairly comprehensive pathway to production so far. Since 2016, we built out a proof of concept that demonstrated that post-trade clearing and settlement for the Australian cash equities market could feasibly work on a blockchain, and to really explain and demonstrate what are the likely benefits, not just for the ASX, but for the participants in the market. So that was a major first step, but then the real next step that we had to go through was a more complete functional and non-functional test to prove that this technology was good enough for production. One of the things that's often skipped over when people talk about distributed ledger technology is what does it mean to actually be production grade? And digital asset has been very fortunate to be put through our paces by an organisation like the ASX in actually proving out that it's not just the fundamental core flows that can be done, but all of the exception management processes, that it can perform at scale and it can perform with the resilience that's actually needed for a major market infrastructure. So for us, the opportunity to work on the cash equities post-trade market in Australia has been probably the major defining project that we've had to date.
Okay. So you mentioned reconciliation as a challenge in the securities post-trade space that you're working on. And I'm going to ask you both, John and Gangesh, what are the major inefficiencies with post-trade that you feel blockchain technology can assist with, based on your experience, beyond reconciliation in your case?
Yeah, so reconciliation is one of them that we're working on. The second one is sort of, another interesting application that we worked on, and I've actually solved it at scale for one of the large financial institutions. We'll be announcing this later this year. We've been working with this institution for about 3 years. Globally, they're one of the largest financial institutions. They're one of the regulated players in the US. In the application, we call it as event lineage. In what is event lineage? Event lineage means given any book entry that they have in any of their in any of their different books or records, how did this book entry come about? Right. So if I'm if I'm presented with a book entry, how did this book entry come to be what it is recorded as? What are all the events that happen inside my financial institution and at all my different counterparties and anyone else that have been part of working with me? How did they enrich, modify, transform, or create events that eventually resulted in this book entry? Or given any event anywhere in this network, how did this event eventually transpire and end up as a book entry in multiple of these financial institutions? So we call this event lineage, and in event lineage, essentially what we're basically trying to do is connect events across various front, middle, back office systems inside an institution and across multiple financial institutions. We essentially provide an end-to-end view. And the end-to-end view might be used for business analytics, might be used for operations, might be used for exception processing, might be used for automating some of the workflows that are there, because unless you actually understand what's going on, it's hard to go and say, I want to automate something. What are you automating? Well, you can automate only when you have visibility into events. It so happens in financial institutions, as we've talked about, there's so many different systems within a financial institution that serve different purposes and so many different players in the market that it's hard to get this type of end-to-end visibility into any of these applications. So we worked with one of the largest financial institutions to solve this problem as well, end-to-end visibility. Of course, once you have end-to-end visibility, you can actually build reconciliation with that. Because now that I have end-to-end visibility, I can automate the process of reconciling. I know what has happened, therefore, if there is an exception, I can know what to do to actually fix it. So these are sort of the problems that we focused on in the post-trade space.
Maybe follow-up questions on that. How does blockchain applies to this event synchrony or visibility collection in a way?
So I'll describe this in a little bit abstract terms, but hopefully this will be easy enough to understand. So let's say I'm sending a Bitcoin to John. Yeah. What is it that I send to John? The simplest explanation of what I send to John is that I'm just giving a token to John. It so happens that in the process of sending this token to John, I've actually done a lot more things. Mm-hmm. To send the Bitcoin to John, I actually constructed something called a Bitcoin transaction. This Bitcoin transaction is constructed using something called a Bitcoin scripting language. Bitcoin actually has a scripting language. I write a transaction in the scripting language. I then sign it with my private key, and then I send it to John. When I write this transaction, what I've actually done is written a little program that says how I got the Bitcoin. And in fact, I'm linking it to what's called the unspent output of a past transaction that I had received, and I send this to John. So John receives it in his wallet, and John's wallet is not just like really an account or anything like that. John's wallet is actually a little more sophisticated than that. John's wallet is a little container which actually executes this program that I've sent to him, because the transaction I've sent to him is actually a little program. So John's wallet executes it. It verifies and validates whether the keys, the signatures, and everything are okay. It then verifies whether the transaction itself is correct, whether it's correctly linked to a past unspent output. It validates it. So when you get a transaction in the Bitcoin world, you actually know where it came from, right? Now, what we do now is extend this concept all the way. What we mean as event lineage is when I create an event in a financial institution, and that event goes from one system to another system, we essentially use the same concept. Now this event at the second system knows exactly what created this first event, and we've essentially created an end-to-end link of such events. And this is what we call as event lineage. And so the technology of Bitcoin, blockchain, and distributed ledgers is very, very appropriate for solving this problem that we call as event lineage. This is really what we mean by event lineage, and this is why we think this technology is appropriate. Now, this is not the only thing that's needed for solving the problem, but this is one of the key components to solving this problem.
I now better understand what you were explaining. Thank you so much. So, John, on your side, and then we'll ask financial institution questions.
So from a post-trade perspective, I think for us it really boils down into three buckets. The first is data synchronization, which Gangesh has already really delved into. I'll add a few little points on it, but data synchronization across entities is a key one. The next one is complex multi-party workflow automation. But then the third one I think is perhaps the most important, which is the fundamental technical approach that financial institutions have taken to build or buy or adopting a common platform. And so that's probably where I'll finish up. Starting with the data synchronization problem, to think about it like a computer scientist, markets everywhere are effectively state machines, and what they're trying to track is the current state of the rights and obligations between the different parties in a given network. Fundamentally, from a technical perspective, today the dominant paradigm has been either API-based or message-based, and those are both fundamentally asynchronous technologies. As Gangesh pointed out, me sending a message or me sending a report is very much like me taking a snapshot of my database at a particular point in time and asking you to check your database against it. What we're effectively trying to track in a marketplace is in real time who owes who what and who has to do what. And in order to do that, there is a fundamental opportunity to shift from a state where we're only certain of who owes who what at the end of the day once we've completed our batch reconciliation processes, to one where we can be certain of it throughout the course of the day. And we think that that's a fairly significant opportunity. It has significant implications, for example, for things like collateral management, for things like risk management. So that, I think, is quite significant. The second thing is complex workflow automation across multiple different parties. For many banks around the world, and certainly it was the case at CBA, the pinnacle of what we were aiming for was straight-through processing with many of the things that we were talking about. And that's feasible when you're talking about an operation that's constrained to a single organisation. Things like opening a new trading account or opening a new bank account can be controlled entirely by that one financial institution, and the opportunity exists to extract the humans from the process, and in so doing, reduce cost and reduce risk. That's quite significant. But when you start to look at the operations of markets, there are plenty of things, and corporate actions are the best example, where to deliver a service to your end client, you actually need to interact with multiple other institutions. Things like rights issuances might need to be touched, like this is a voluntary corporate action in an equities market, might need to be touched by 7 or 8 different entities, and may take 15 or 20 days as a result. And so the opportunity exists with distributed ledger technology, once you've got the state machine right, once everybody's on the same page with their data, the opportunity exists to automate processes across multiple different parties, identify where things are broken, and tighten the loop beyond what's possible today with asynchronous and uncommon systems. The last thing to point out, as I said, was the notion of the approach that financial institutions have taken to technology. First and foremost, the back office hasn't had the same level of investment that the front office has. Over the last 20 years, there's been an absolute arms race to get down to microsecond level trading in the front office. But the back office has really stayed unloved and unwanted, at least until this whole blockchain thing came about. And what I think is now happening is that people are starting to look at those back offices as areas of opportunity, areas of new revenue, and certainly areas of cost saving. The macro trend against the back of this is that we live in an age of increasing regulatory velocity. Regulators all around the world are saying that my rules don't just apply in my little geography, but in fact to all financial institutions all around the world. GDPR is just perhaps the latest and most well known, but MiFID came before it, FATCA came before that. There's a whole range of these regulations that are starting to roll out across the globe that affect every single financial institution. And when you think about a specific geography, we're here in Singapore, there's a large number of financial institutions that are all fundamentally trying to comply with the same set of rules. They're trying to comply with the rules of the Singapore Exchanges market. In Australia, they're trying to comply with the Australian Securities Exchanges market. But what we have today is a state where you've got potentially 120 different systems in Australia trying to comply with a single set of rules. And the challenge that we perceive is that whenever those rules change, you've got 120 different systems that need to be changed, back-tested and checked to make sure that you haven't broken anything. And what you end up with is a situation where the status quo bias is very strong. Not changing, not improving, not amending is absolutely the approach that most people will take. And when I talk about CBA, I was in an innovation lab that had a budget of $5 million a year out of a $2 billion technology spend. And so what you're seeing there is that a lot of the interesting things that technologists want to be doing can't be done because all of this money is being spent just keeping up with the technology change. The biggest opportunity that we see for blockchain platforms is for them to become common platforms across financial institutions that are all seeking to do similar sorts of things. It's not going to take over the things that add value about your institution, the things that differentiate you, the things that give you competitive advantage. But all of the stuff that everybody has to do, there's an opportunity to commonise and mutualise the cost of that change and the cost of keeping up to date. And we think that that's a major one that's coming for the back office.
Thanks a lot. To Margaret, so we see banks participating to consortium, whether it's R3 or Hyperledger, where we participate as well as Swift, to try to build common solutions, a bit to what you just explained, that banks can use together and streamline their processes. Others are taking a different approach, like the most known one would be JP Morgan with their Quorum-based DLT system, where actually they kind of trying to spin it off from the JP Morgan because they understand that having it linked to a specific bank might be an impediment to having it used by other banks. What is the best model, in fact? Do you think it's viable for a commercial bank to hope that its blockchain system will be used by other banks, or is it more the consortium-based approach that will work? What's your view on that?
Well, my first view is hope is not a strategy, so we should probably keep that front of mind as we now consider this question. I mean, you're absolutely right, and in the examples that you've given, and I'm sure things that were talked about both yesterday and throughout today, it's very clear that fintechs, financial services companies, are all experimenting, embarking upon a whole range of sort of private blockchain projects. Undoubtedly, there are many advantages over or with private blockchain versus the sort of classic database used currently by banks, whether in terms of both keeping transactions and also reporting back to their clients or to third parties. And I think several of those things stand out quite prominently. Certainly, the strong security and cryptography and digital signatures that we've talked about relevant to blockchain are pertinent. The immutability, it's clearly not possible to adapt or tamper with any record without changing the entirety of the blockchain. You've got minimised risks around double spending due to the algorithms that get used in the technology. And because of decentralisation, which you've already talked about this morning, there isn't that single point of failure that again exists in a lot of the infrastructure today. albeit that, yes, cloud technology may be part of that solution, but I'm also very aware for a number of banks, deployment of cloud is not something that is possible and is still being very strongly scrutinised by many regulators over the world. So clearly with that, I suppose that drive and those advantages, it's obvious that different organisations are looking to build solutions. But I do think we need to be very conscious and think about future integration. We've already remarked banks don't do very much in isolation. The world in which we operate is absolutely borderless in every dimension of that word. So, we need to think about whether the world needs to be aligning behind common standards, because I don't think we can expect that, every private blockchain initiative developed independently would have mass adoption around the world. So as you start to think that through, it's, easy to surmise that any project driven by central banks, central authorities, even an effective consortium seems certainly conceptually to be more likely the solutions that potentially would succeed, because it would come with certainly a broader set of consistent standards for people to work towards. And I think then when you think about certainly, or unlike public blockchains, permission blockchains do require governance and a control framework. And so when you think about that, you need to think about what's the types of assets that are going to be traded and recorded within the DLT. You need to think about approval for onboarding or offboarding participants in the DLT. And you need to think about the process of data validation and recording on the blockchain. Again, things that we've already touched upon. So recognising that, again, it comes back to mind that it is perhaps central authorities, consortium and regulators that would be in a better position to create a framework that's likely to be trusted and accepted by the industry, and therefore is likely to take hold potentially more quickly. So that's at a conceptual level. I guess my challenge to that would be that when you look at past performance, which isn't always an indication to the future, how many hugely successful consortia, international collaborations, driving of new standards in the industry do we see? The reality is it's very hard to make them come to bear. It takes a huge amount of effort and energy, and it takes a damn long time. So, with some of those impediments, you can see that commercial ambition, levels of innovation in the commercial market, you could see individual initiatives, I think perhaps not so much from financial services companies or only financial services companies in strong partnership with fintechs, perhaps giving a very different route forward.
Makes sense. Danielle?
So I'd have to echo many of Margaret's comments, and I think particularly for the public market asset classes, that will be very much the case, where we'll be looking to work with market infrastructures and regulators. There is a certain advantage to that consortium-style approach or regulator or exchange-led initiative in that it brings the industry along, and what we are seeing is far more collaboration than we have in the past. I think in the past they'd have just built it and told you what needed to be done. And I think we are seeing higher levels of industry engagement and research into the technology and its capabilities prior to going down this path. But the journey and the disadvantage of that is collaboration takes a lot of time. Often you need to build consensus and a strong position. Often that means the middle ground, so you may not get the most aggressive or competitive style solution. Or solve all your problems in day one. So that just takes time. But as large organisations servicing very complex client base, that's a path we have to take. I think there is also a large asset class that doesn't sit within the listed market space. They still have a high degree of inefficiency, a lack of infrastructure, a lack of standardisation. We are still dealing in paper-based contracts, fax and email. And that's an area where I think there is a role for still either consortia or private initiatives to lead change. And Regardless of that, though, you still have to start with the problem you're trying to solve. You have to serve the value of the clients you're trying to address that, and you have to collaborate and have high levels of engagement with stakeholders to drive adoption. So I think both approaches are valid, and for global institutional players like Northern Trust and Standard Chartered, we probably need to be active and monitoring both.
Yeah, sure.
Can I make a comment on this one? And this is sort of just a comment and sort of an opinion. I think John pointed out something earlier, and that was that in general, for a number of different years, the back office systems just hadn't had a whole lot of attention. There's a lot of reasons for it. The 2008 financial crisis actually made everybody sort of be very reactive. Post that, everybody had to actually upgrade their risk systems. Most companies had to spend billions of dollars on risk systems. Obviously, compliance was a big part of the cost, so everybody spent lots and lots of money, brought consultants in, outsourced various functions, somehow made themselves compliant to all the different rules around the world, to all the different regulatory bodies and authorities, right? But one of the things that has happened in the last 20 years, and most people in sort of the database world know, sort of the entire big data revolution happened roughly around the same time. So over the last 10 years, 20 years, big data technologies have come in. They're very complex distributed technologies that allow you to process data at scale. This is what powers almost all the cloud and internet companies out there. The Googles of the world have invented all kinds of technologies that do things, databases at scale, horizontally scalable system versus the traditional, IBM Oracle database style vertically integrated systems. So, what we are therefore seeing is that in this middle back office space within the financial industry, the space is so big that the opportunities are vast. Just because someone is actually looking at a consortium style problem for some solutions doesn't preclude other parts of the institution to actually look at other solutions that use parts of the blockchain and be very successful. In fact, we rarely talk to the same people. I mean, as a company, we rarely work with the same people that are working, for example, with, say, R3, or even with digital assets for that matter. Everybody is solving different parts of the problem. Eventually, the long-term vision, 5 years, 10 years, 20 years, 30 years down the line, these solutions may converge, yeah? But we don't have to wait for 20 years, 30 years for something to happen. Consortia may take, some time to take, and there are other people that are very actively working on consortia, and we are very active in supporting them, and when standards come about, we'll actually adopt those standards as well. But at this moment, we kind of look at it and say, there's lots of problems that large financial institutions have. Let's go and solve some of the problems with the technologies that are available and make them as good as they can be. And all the institutions out there, ASX is an example, we are working with some of the largest financial institutions, are trying to take advantage of it. They're not waiting necessarily to say, let's wait for the entire industry to come in and work with us, because while they will certainly try that approach, they'll also try the other approach, which is, can I get advantages today, and can I reduce my operational costs, can I make my risks lower, can I make some workflow much simpler?
So this is all good, and actually you touching on the next question, which is good. Consortium takes time, agreeing on standards takes time. Guess what, Swift has been doing that for 40 years, so we know what we're talking about, but it works, so it does work, yes. And effectively, before we reach this level of harmonization or agreement on how it should be done, yes, we should not be staying still for sure, and we should be doing stuff. But what can mitigate the risk of fragmentation? Actually, I'm going to ask John on that. So we know that there will be fragmentation of technology for the foreseeable future. The different systems different blockchains that are being built are different, using different technology. There is some convergence on some aspects of blockchains, but not on all. What could be used as a mitigating factor to make sure that we're not ending up into a world that is not interoperable or very difficultly interoperable or very costly to interoperate?
I think Gangesh made a very good point there that this is a journey. This is something that's going to take a number of years, potentially decades, to get to a point of full convergence. And there is a lot of opportunity in the short term. What I think that means in terms of colouring the answer to this question is that the interoperability that matters in the short term is not my blockchain with your blockchain. with her blockchain. What it actually is interoperability between the blockchain and the technologies that exist today. Digital Asset is one of the organisations that's taking that very seriously, because one of the fundamental requirements of working with the Australian Securities Exchange is that you can't pull out the old system on Friday afternoon, plug in the new one on Monday and expect everybody to just go with you. What you need to be able to do is interoperate between a blockchain future and a current day messaging standard. And so the digital asset platform has very specifically been built to speak ISO 20022 messages, the message standard that is being introduced across the world for securities processing. And organisations like SWIFT have played a big role in not just working with the ASX, but also in driving that adoption of standards across Asia and across the world. And so I think in the short term, to avoid the fragmentation between the next stage and the current stage, you need to be strongly interoperable or strongly backwards compatible between those two forms of technology. In the longer term, yes, I fully agree that there will be a need to move towards standards, but the real balance that needs to be struck, as Gangesh pointed out, there's a hell of a lot of opportunity. There are so many processes that are currently built off macros and spreadsheets that sit in somebody's folder on a computer in a bank, that the opportunity exists to improve. And what I think you'll see and what you've already seen, particularly in the enterprise blockchain space, is a bit of a Cambrian explosion. And that Cambrian explosion is targeted at solving each and every one of these different and discrete use cases. I don't think that there'll be one blockchain that rules them all. I think that there'll be the emergence of dominant standards in specific areas, whether it's trade finance or health records or indeed security services. And gradually they will converge, but in the short term the opportunity exists to optimise them as much as you possibly can to solve the particular problems that you're going after.
Makes sense.
Yeah, I would echo exactly that. And what we see is that some of the newer technologies that have been built over the last 10 years, right, allow this kind of interoperability to happen easier than before. What I mean by this is that if you sort of look at it, say 20 years ago, the problem of ETL in a database, extracting data from some other database in loading it into a new database or into a different database was a very, very complex problem. You paid hundreds of thousands, in cases millions of dollars to Informatica to actually solve this problem for you. It so happens that much of ETL tools now is available in various forms, in open source communities that is very, very robust. So interoperability across databases, interoperability across systems has become much easier. You can actually use Hadoop. You can use this entire big data ecosystem, which is sort of how we build our platform. We use an entire big data fabric to actually build our platform. And these allow you to connect to all kinds of systems that are out there in a standard way. So what this means is that if you build using these technologies, the future interoperability becomes easier as well, because now you're using newer tools that are already very robust in terms of their interoperability, and any standard that people build, even in the consortia, will likely be very similar to the ones that have already been built. And obviously, connecting to the existing infrastructure, Swift infrastructure, Fix, FPML, these type of securities infrastructure makes the current problems easier, because now you're actually making sure that the legacy infrastructure and the technologies that you're bringing in interoperate seamlessly right away.
You make me a happy man because you mentioned ISO 20022 without me having to say it. So generally I'm the one pounding the number out. Because yes, I have a little motto, whatever technology, ISO 20022 is there for you, for sure. So conscious of time, I still have questions on my list, but we have only 10 minutes left, and so I would like to give the opportunity to the audience to ask questions, if any, and if not, I have a few more questions for the panel. Very silent crowds. Yeah.
Hi, Clifford Chance, Paul Landless. Just, I'm a lawyer, so I have to ask some regulatory questions. Basel and the FSB are noticing the increasing level of collaboration and the increasing integration from a middle office perspective of newer systems, and that sort of integrated systems risk is becoming a new obsession of regulators. And there's this new focus on outsourcing. and a new sense of third-party dependency or operational dependency. Do you think the regulatory response could become a brake on added interaction and added integration of systems or standard adoption?
Anybody?
I'm happy to address it. I think those standards have always been there. We are starting to see some of those considerations around concentration of risk to providers, certainly in the cloud space. That's you're starting to see that already. I think it will just become part of planning and testing around some of these emerging technologies. So I know that that's certainly what the ASX is thinking about. And the technology concentration is there, but also the technology can help solve that as well in terms of the redundancy risk and backup. So I think standards will need to evolve from a regulatory perspective.
Actually, I have maybe a last question, and then we can give the floor again. It's about disintermediation, because I think it's an important topic. The technology may lead to the disintermediation of some actors who really are becoming irrelevant in a world where the truth is available everywhere in a blockchain environment. I'm not going to be maybe make some people unhappy in the room, but to me, for example, registrars should have disappeared in the 1980s. They still exist. You don't really need a registrar in the past. You certainly don't need a registrar if it's about re-registering the name of the beneficiary owner in a blockchain environment. For banks like you as well, especially custodians, there's also questions of, do we need a custodian if the customer can access directly a platform, for example? So what security services players like you and you should do to stay relevant first, that's why, and do you believe that you're still relevant in that type of ecosystem? Asking the question a bit more direct.
I'm happy to start. So I'd say, I think what's important here is that we need to always focus on how we continue to add value to our clients.
Yeah.
And that is not a static story. So in the past that was managing settlement, whether that was taking the piece of paper across to the broker office when it used to be done that way, or connecting to STP market tools to deliver instructions. So I think as custodians we have to continue to evolve on how we deliver asset safety to customers, how do we reduce transaction friction and give them transparency. We also have to remember, I think this is about coexistence. So this is about these emerging technologies will continue to grow along with legacy technologies. And then we have to also remember that some clients will continue to want to use intermediaries for the value that they add. That can be market access, that can be regulatory expertise, that can be consolidation. Global custodians can cover up to 100 markets and 30 asset classes. That's a lot of complexity. And some institutional investors, that's not necessary if they're a single market focus and fairly simple investment demands. But for others, they're highly complex and they manage billions of dollars and use multiple parties. So I think this is about continuing to evolve value for clients and a comfortable coexistence of both.
Makes sense. Margaret?
Well, I hadn't seen Danielle's notes, but I guess
the
a lot of my answer would be very similar. But maybe I'll begin by saying, disintermediation is not a new threat. It's not unique to security services nor to banking. It's always existed. And the key, which we've remarked upon, is maintaining that ongoing relevance to clients. And if you lose your relevance, then you lose your survival, you lose your life. So I think with how we consider our response to the advent of new technology, is just another, I suppose, evolution or chapter in that journey. So it doesn't mean that it means that I'm aware of the issue. I'd go on to say then that I think DLT in the post-trade space is still a number of promises. It's not yet today's reality, but that doesn't mean that I'm complacent. So as I think about it, probably two things stand out. Firstly, I don't anticipate that there will be wholesale disintermediation overnight. Already the panelists have spoken about the level of complexity that exists even in a single organisation, never mind multiple organisations in the same country or indeed around the world. And there is a lot of work to be done to start to solve problems at an individual level, not on a sort of a wholesale worldwide basis. I think as well, and when you think about this borderless world in which we operate, there are different nations involved. Different countries will accept technology, adapt regulation around technology in a different way and in a different time frame. So again, the pace of change is not going to be singular. The dynamic is very complex and will be driven in a different pace across the different geographies in the world. And I think that's something else to think about as we're, grappling with interoperability and what that looks like in the future. So for me, will security services players still exist? Providing we have a relevance to our clients, absolutely yes. But my relevance today will not be the relevance I have tomorrow, as indeed it wasn't the relevance that I had yesterday. So the challenge and perhaps the call to action for us is, how are we showing agility? How are we showing readiness to respond? How are we reinventing ourselves, new business models, new services, new products, so that we are instrumental and part of the lifeblood of the clients and the clients' organisations that we support. I don't know that we've got the answers to that there, but I think as an industry we are starting to work on that. Examples for me definitely exist in the data space. We've heard already banks hold a colossal amount of data. Historically, we haven't been great on finding a way to create meaningful customer-led solutions to provide value-added data to our clients. We're getting better at that. I think we need to accelerate our propensity to perform in that space. Because if we can bring a different level of insight to our clients as they run their businesses, that is value add. That helps to maintain our relevance going forward. That helps to ensure and develop client relationships, and that will minimize the threat of disintermediation. I think as well that whole piece of data is not just driven by what we do as a single institution. So again, how can banks use the platforms that they have in a more open environment? How do they collaborate more effectively with existing partners and actually a new range of partners so that the technology, the knowledge that they have is combined very powerfully with other things, again, to create new value in the mind of the customer. So that's the challenge, I think, for security services providers and probably for banking institutions more widely. But if we don't get on with it, then our right to survival certainly will be clearly questioned.
Yeah, on this disintermediation, the most often question I get is, with blockchain, will SWIFT survive, right? Well, I remember having the same question when internet came along. Yeah. I remember having the same question when cloud came along. I remember having the same question when APIs came along. And, well, first, we're still there. And why? Because it's, as you just mentioned, it's just a question of making sure that the service you offer to your customers is what they're expecting, right? And it will be a combination of all those technologies. And if we embrace that, there's no reason why anybody should disappear, right? It's responding to the customer demand. That's my little bell to say that it's the end.
Perfect timing.
Yeah, I know. So do we still have 1 or 2 minutes for questions? Yes. So do you have questions behind you? Someone is raising his... Yeah.
Hello. My question is for Northern Trust, and I'll try to keep it short, but 3 parts to the question. 1, your experiment in the private equity funds, GPs, LPs, fund admins, private banks. So in your experiment, who were the partners who participated? Second, how did you tackle the privacy around capital calls, fund equalizations? Different LPs don't want to see the others' data. Which protocol did you use to address that? And the last question, what is your biggest learning in terms of where the efficiency gains are of using a distributed ledger against current systems? Thank you.
Right, I'll try and answer all those 3.
Very good question.
So first of all, it wasn't an experiment. it was live, so these were real clients and real funds. To the answer of who was in the party, everybody. To build a real life cycle event, you have to include the general partner. It was a Swiss-based fund, Unigestion, 20 billion in assets under management. We paralleled one of their smaller funds. We had limited partner investors, a small handful. We had their accountants and lawyers and auditors involved, and we had regulators. So this had to be the full life cycle, which meant all parties to the ecosystem. So that's not an easy thing to manage. In terms of the privacy, then it's about permission structures. And again, you're dealing in very sensitive commercial data here, so we needed a permission framework. We built the system with Hyperledger Fabric. I can't talk to much of the technical detail, but that would have been part of the planning. And the third piece?
Privacy.
Privacy.
Yeah.
Yeah, well, that comes back down to permissions. So the biggest learning, that was the final piece. Really here, again, I think it's about, we didn't start the conversation about disintermediation. We were just trying to see what was the issue for our clients in managing this asset class. We brought stakeholders into the journey and made them part of the solution. And we allowed them all to realise, to remove some of their own frustrations. So we just didn't build it to fix Northern Trust's problem. We allowed auditors to innovate over the way they conducted audits, and we allowed investors to benefit from transparency and efficiencies, and we allowed general partners to get access to fund level registry data. So I think it was about allowing the platform to deliver value and then for everyone to be able to innovate off that.
Thank you. Other questions? We have one question there. Then you have to tell me when we have to finish, because I don't know. Yeah.
Hi, this is a message for Swift. At the beginning you talked about you tried using blockchain technologies, and you said you ran into some problems around the fact that you had like millions of subledgers that were created. Could you elaborate on the problems you found when you tried your proof of concept?
Well, so we did an experimentation last year around our GPI offering that that Raoul mentioned yesterday, if you remember. So this is a payment, accelerated payment infrastructure. We didn't want that to be on blockchain. We wanted to have the visibility of liquidity to be on blockchain and test how blockchain could help Nostro account reconciliation in a way. So a bank having real-time visibility on movements of cash in and out of his account, as simple as that. So the technology worked perfectly well with the 28 banks we work with, so the results were positive, but we quickly realized that in order for that to be scalable at the level of SWIFT, which is 11,000 financial institutions, 6,000 banks probably doing correspondent banking or something like that in the middle, that led to the creation, I'm not a techie neither, but of private channels between the banks on Hyperledger, and I'm not sure it's the right terminology. And the number of those private channels, i.e. subledgers that needed to be connected to one another, was, if you would take it to the scale of SWIFT, would be so big that we were questioning the viability of how these could be monitored, this could be organized, this could be managed and maintained, as simply as that. It doesn't mean that we scratch blockchain as a solution for that. We just think that on this experiment, we were not yet completely persuaded that it would be a scalable solution at the level of SWIFT, at the level of cross-border access that we have today. We're still experimenting blockchain, and we will continue experimenting on different use cases. The next one I mentioned is proxy voting, because we do believe that the technology will have a use cross-border, and we certainly see that it has a use domestically, where the number of players is limited, the number of the legal frameworks is the same, and so on. So cross-border, the jury is out, I would say.
Just to pick on that, we've worked with one of the largest financial institutions and have built a payment application for them. It's part of a broader, securities application, but it's an at-scale application, and they're actually, putting it in production now, and they run $4 trillion a day through it. Right, so So the technology does scale.
On
Swift ran
volumes,
into
yeah.
other stuff. They had other challenges, but different institutions have done it in different ways.
Yeah, but the volumes was not the problem. It was most the number of players interacting with one another. Let's be clear on that.
Sure.
So I think we need to close. I got a thumbs down or up, I don't know, from the team. So thank you very much. I think it was a very good discussion. At least I enjoyed it. I hope you enjoyed it. And next is breakfast. No, lunch. Thank you.